If you look at the data, 80s, 90s, 2000s, you'll see that inflation came down during times when the economy was very strong. Why? It's because of productivity. Productivity growth is a byproduct, and a critical byproduct, and an anti-inflationary byproduct of good, strong recoveries. Interestingly, one price indicator associated with innovation is beginning to hold up better than other prices, and that's Bitcoin. It's been interesting to see it flatline in the last month, while other indicators are reaching for new lows. Now, this is not surprising in the late stages of a bear market. In our experience, innovation starts to outperform in the late stages of a bear market. Why does that happen? It happens because innovation is the new leadership. Innovation solves problems. Innovation solves the kinds of problems we have today: supply chain, food, energy shortages, think the genomic revolution, electric vehicles, and so forth. And so we believe that innovation should outperform if we're toward the end of this bear market. If the Fed's close to pivoting, even in its rhetoric, I think we are. Steve Vanelli, who is the CEO of Knowledge Leaders Capital. And Steve has done factor analysis, uses factor analysis. He's somewhat quantitative in his orientation, and has defined innovation as a factor. And according to his quintile spread for the R&D to sales ratio factor, he believes that the major underperformance is done. And if you look at the PE to growth ratio of the innovation index that he has derived, it is now selling at a 31% discount to the PE to growth, or the PEG ratio, of the S&P 500. And he noted that this innovation kind of strategy bottomed in May, whereas the broader-based indices, which we would submit are being disrupted, they hit new lows just in the last 10 days. So stay tuned for more discussions about innovation and where the world is going and how innovation is solving problems. So with that, I guess I'd like to reassure you that it feels like we're moving towards a cathartic moment. And, I think that the 75 basis point increase, if that's what the Fed is going to do, is going to result in some financial signals that the Fed will have to pay attention to. Maybe it didn't have to pay attention to the guilt trip, but it should, because it is the reason it should have the guilt trip, because it is the reason that that near Lehman event happened in the UK. And so it is darkest before the dawn. We think the pivot is close, if in nothing else but rhetoric in the short term. And we certainly hope that the Fed gets away from this need for unanimity and a united front, when really we have all of these Fed members and presidents for a reason to debate. And we feel that debate is being stifled. The debate should be driven by data, but it cannot be. If it were, they would not be unanimous in their thinking right now. So let's hope there are some dissenters, and let's hope there's some rhetoric change. There are all kinds of reasons out there, data-driven reasons. And so we hope the Fed is paying more attention to all of the data instead of just a selected few pieces of lagging indicators. Markets are selling off across the board, and that's very unusual. It's associated with crises. and more convincing evidence to us that the Fed is too tight and that it will pivot. And when it does, it will do so, we think, significantly. Now, first, it might simply be rhetoric, because they always like to tee us up for what the next moves are going to be. And we haven't heard that rhetoric yet, despite all the evidence I just shared with you. But that evidence I just shared with you tells us that the Fed is going to get the message loudly and clearly somehow. And it may not be showing through in the numbers they want to see, but it will. It will. They are huge lagging indicators. They're basing policy on lagging indicators, not what they're supposed to be doing. Anyway, if you take, in the US alone, if you take equities and bonds and look at what's happened since the peak, you will see that the loss to investors is more than twice what we saw in 08-09. That's how bad this is. Because bonds are selling off with stocks this time. So and one of the reasons for that is a seizing up of liquidity. As I mentioned, if people are facing margin calls or in financial difficulty, they're going to sell their most liquid asset. They will have no choice, especially with margin calls. Most liquid assets tend to be government bonds, and I think that's why we're seeing the backup in government bonds here, despite all of the deflationary signals in the pipeline. It's just the last month. And we found 22 firm or strong indicators suggesting employment and inflation might linger at a higher than expected rate. And we found 22 weak indicators. Now, pulling out the ones that are specific to employment and inflation, since those are the two variables that the Fed is weighing more than any other. And we find that on the firm side, what they didn't like was core CPI and PCE at 0.6% month to month. Even though the headline indicators were flat to down, the PPI core 0.4, and non-farm payroll, which came out today, pretty much in line, 263,000, but there was a drop in the unemployment rate from 3.7% to 3.5%. Now, the reason for the drop was the labor force, not employment, the labor force shrinking. Labor force participation ticked down. So I don't take that reason as seriously, because we do believe labor force participation will, on balance, continue to trend up, especially if we're in as weak an economy as we believe. So on the weak side, again, if the Fed were data-driven, it would be paying attention to employment in the ISM index for September. Below 50% means it's contracting. The job openings, so JOLTS, they dropped 1 million in 1 month. Now still strong at 10 million. They dropped 1.1 million. That's a big drop in just 1 month. So job openings are declining. We're also seeing surveys out there. I think in the U.S., among major employers, 300 have announced layoffs, and that's reflected in something called the Challenger Layoff Survey. And those layoffs, which are broad-based company layoffs, are up 68% year over year.